Hello students, welcome to the lecture on export credit, and after this lecture we will be able to learn the following objectives. Discuss about the borrowings in foreign exchange under the automatic route. Describe the borrowings in foreign exchange under the approval route. Understand Exchange Rate Management Act. Explain highlights of FEMA. Understand discounting trade acceptance. Let's start with the concept of export credit. Governments support export credits in broadly two ways: through direct loan and subsidy programs and through insurance and guarantee programs. Under direct loan programs, government institutions extend export credits directly, often in association with private financing. Under subsidy programs, governments operate indirectly on export credits by extending preferential refinancing and interest subsidies to private lenders. For example, in the United States, Canada, and Japan, official export institutions lend directly to both domestic exporters and foreign importers at fixed subsidized rates, and in Germany, France, the United Kingdom, and Italy, official institutions combine direct lending, refinancing of private export credits at preferential rates, and interest rate subsidies to achieve similar results. The subsidy and official supported export credits arises in several ways. Loans are made at fixed rates to borrowers who would normally qualify only for variable rate loans at maturities generally longer than available in the private market for comparable loans to such borrowers, and at lower rates than these borrowers would otherwise pay. Governments also subsidize exports through loan, insurance, and guarantee programs when they sell insurance and guarantees at prices below their true market value.
An export credit agency, also known in trade finance as ECA or investment insurance agency, is a private or quasi-governmental institution that acts as an intermediary between national governments and exporters to issue export financing. The financing can take the form of credits or credit insurance and guarantees, or both, depending on the mandate the ECO has been given by its government. ECAs can also offer credit or cover on their own account. This does not differ from normal banking activities. Some agencies are government-sponsored, others private, and others a bit of both. ECAs currently finance or underwrite about $430 billion of business activity abroad, about $55 billion of which goes towards project finance in developing countries, and provide $14 billion of insurance for new foreign direct investment, dwarfing all other official sources combined. As a result of the claims against developing countries that have resulted from ECA transactions, ECAs hold over 25% of these developing countries' $2.2 trillion debt. These data are unreliable in the absence of source, definition, or date. Export credit agencies use three methods to provide funds to an importing entity. 1. Direct lending. This is the simplest structure whereby the loan is conditioned upon the purchase of goods or services from businesses in the organizing country. 2. Financial intermediary loans. Here, the export-import bank lends funds to a financial intermediary, such as a commercial bank, that in turn loans the funds to the importing entity. 3. Interest rate equalization. Under an interest rate equalization, a commercial lender provides a loan to the importing entity at below-market interest rates, and in turn receives compensation from the export-import bank for the difference between the below-market rate and the commercial.
Let us now discuss the borrowings in foreign exchange under the automatic route. Under the automatic route, the lender can lend and borrower can borrow without prior approval from the Reserve Bank of India or the Government of India. The RBI Master Circular mandate on the following for the ECBs under the automatic route. Eligible borrowers: registered corporate, including those in the hotel, hospital, software sectors and infrastructure finance companies, are permitted to raise money through ECB except financial intermediaries like banks, financial institutions, housing finance companies, non-banking financial companies other than those specifically allowed by RBI. Individuals, trusts other than those involved in microfinance activities and non-profit organizations are not allowed to raise ECB. Units in special economic zones. However, they cannot transfer or on-lend the money obtained through ECB funds to sister concerns or any unit in the domestic traffic area. Non-government organizations engaged in microfinance activities are permitted to avail ECB. Microfinance institutions, MFIs, registered as a society which are engaged in the activity of microfinance are permitted to engage in ECBs. Recognized lenders. International banks, international capital markets, multilateral financial institutions, regional financial institutions, development financial institutions, export credit agencies, suppliers of equipment, foreign collaborators, foreign equity holders apart from overseas corporate bodies. Amount and maturity. Following are the sector-wise limits on the amount of ECB proceedings that can be raised during a financial year. Permissible ECB proceedings. Corporate, other than those in hotel, hospital and software sectors, INR 4,875 million or its equivalent during a financial year. Corporate in the service sector, hotels, hospitals and software sector, INR 13,000 million or its equivalent during a financial year. NGOs engaged in microfinance activities are microfinance institutions and INR 650 million or its equivalent during a financial year. End use. According to the Master Circular, the proceedings gathered from the ECB shall be used for the following purposes: growth, expansion, diversification of existing production in industrial sector including SMEs, small and medium enterprises, overseas investments in joint ventures and wholly owned subsidiaries, first stage acquisitions of shares in the disinvestment process. Infrastructure companies can use it for payment of interest during constructions, IDC. Now moving on to the next topic, we will study borrowings in foreign exchange under the approval route. The borrowing in foreign currency other than borrowings under Schedule 1 by a person resident in India may be made under any of the types set out in this schedule. The application for the approval of the Reserve Bank under Regulation 6(2) for borrowing under any of the types where its approval is required shall be made in the form as specified by the Reserve Bank from time to time. Eligibility. The following entities shall be eligible to apply for foreign currency borrowings under the approval route: any corporate registered under the Companies Act 1956, financial institutions dealing exclusively with infrastructure or export finance, lenders. The borrowings in foreign currency by way of issue of bonds, floating rate notes or other debt instruments by whatever name called may be made from international bank or export credit agency or international capital market, multilateral financial institutions namely IFC, ADB, CDC, etc. Foreign collaborator or foreign equity holder as specified by the Reserve Bank. Supplier of equipment provided the amount of loan raised does not exceed the total cost of the equipment being supplied by the lender. Purpose and use. Borrowing in foreign exchange in terms of this schedule may be for any of the following purposes, namely for investments such as import of capital goods, new projects, modernization, expansion of existing production units in real sector, industrial sector including small and medium enterprises and infrastructure sector in India. The following sectors will qualify as infrastructure projects, namely power, telecommunications, railways, roads including bridges, ports, industrial parks and urban infrastructure, water supply, sanitation and sewage projects. For the first stage, acquisition of shares in the disinvestment process and also in the mandatory second stage offered to the public under the government's disinvestment program of PSU shares. Maturity. Borrowing up to INR 1300 million can have call put option provided the minimum average maturity of 3 years as prescribed above is compiled with before exercising call put option. Prepayment. Notwithstanding the provisions, prepayment of outstanding foreign currency loan may be made as per the directives issued by the Reserve Bank from time to time. Parking of loan. Amount abroad. The proceedings of borrowings in foreign exchange shall be parked abroad until actually requirement in India. Loan agreement. The loan agreement entered into by the borrower with the overseas lender shall strictly conform to these regulations. The procedure for obtaining loan registration number would be as specified by the Reserve Bank. Drawal of loan. Drawdowns of foreign borrowing and foreign exchange shall be made strictly in accordance with the terms of the loan agreement only after obtaining the law registration number from the Reserve Bank. Debt servicing. The designated authorized dealer AD shall have the general permission to make remittances of principal, interest and other charges in conformity with the guidelines on borrowing in foreign exchange from overseas issued by central government, the Reserve Bank from time to time. Refinancing of existing borrowing in foreign exchange, refinancing of outstanding amounts of loans raised in foreign exchange in accordance with the Act or the rules and regulations made thereunder may be made by making fresh borrowings in foreign exchange in accordance with this schedule provided that there is reduction in cost of borrowing and the outstanding maturity of the original borrowing is not reduced. Let's now study the Foreign Exchange Management Act. Foreign Exchange Management Act, or in short FEMA, is an act that provides guidelines for the free flow of foreign exchange in India. It has brought a new management regime of foreign exchange consistent with the emerging framework of the World Trade Organization. Foreign Exchange Management Act was earlier known as FERA, Foreign Exchange Regulation Act, which has been found to be unsuccessful with the pro-liberalization policies of the Government of India. FEMA is applicable in all over India and even branches, offices and agencies located outside India if it belongs to a person who is a resident of India. The Foreign Exchange Management Act 1919, or in short FEMA, has been introduced as a replacement for earlier Foreign Exchange Regulation Act. FEMA became an act on the first day of June 2000. FEMA was introduced because the FERA did not fit in with post-liberalization policies. A significant change that the FEMA brought with it was that it made all offences regarding foreign exchange civil offences as opposed to criminal offences as dictated by FERA. The main objective behind the Foreign Exchange Management Act 1919 is to consolidate and amend the law relating to foreign exchange with the objective of facilitating external trade and payments. It was also formulated to promote the orderly development and maintenance of foreign exchange market in India. FEMA is applicable to all parts of India. The Act is also applicable to all branches, offices and agencies outside India owned or controlled by a person who is a resident of India. The FEMA head office, also known as Enforcement Directorate, is situated in New Delhi and is headed by a director. The directorate is further divided into 5 zonal offices in Delhi, Mumbai, Kolkata, Chennai and Jalandhar, and each office is headed by a deputy director. Each zone is further divided into 7 sub-zonal offices headed by the assistant directors and 5 field units headed by chief enforcement officers. The main objective of FERA was conservation and proper utilization of the foreign exchange resources of the country. It also sought to control certain aspects of the conduct of business outside the country by Indian companies and in India by foreign companies. It was a criminal legislation which meant that its violation would lead to imprisonment and payment of heavy fine. It had many restrictive clauses which deterred foreign investments. In the light of economic reforms and the liberalized scenario, FERA was replaced by a new act called the Foreign Exchange Management Act 1999. The act applies to all branches, offices and agencies outside India owned or controlled by a person resident in India. FEMA emerged as an investor-friendly legislation which is purely a civil legislation in the sense that its violation implies only payment of monetary penalties and fines. However, under it, a person will be liable to civil imprisonment only if he does not pay the prescribed fine within 90 days from the date of notice, but that too happens after formalities of show cause, notice and personal hearing. The Act has assigned an important role to the Reserve Bank of India in the administration of FEMA. The rules, regulations and norms pertaining to several sections of the Act are laid down by the Reserve Bank of India in consultation with the central government. The Act requires the central government to appoint as many officers to the central government as adjudicating authorities for holding inquiries pertaining to contravention of the Act. There is also a provision for appointing one or more special directors appeals to hear appeals against the order of the adjudicating authorities. The central government also establishes an appellate tribunal for foreign exchange to hear appeals against the orders of the adjudicating authorities and the special director appeals. The FEMA provides for the establishment by the central government of a director of enforcement with a director and such other officers or class of officers as it thinks fit for taking up for investigation of the contraventions under this Act. FEMA permits only authorized person to deal in foreign exchange of foreign security. Such an authorized person under the Act means authorized dealer, money changer, offshore banking unit or any other person for the time being authorized by Reserve Bank. The Act thus prohibits any person who deal in or transfer any foreign exchange or foreign security to any person not being an authorized person, make any payment to or for the credit of any person resident outside India in any manner.
Foreign Exchange Management Act.
The Foreign Exchange Management Act is a 1999 Indian law to consolidate and amend the law relating to foreign exchange with the objective of facilitating external trade and payments and for promoting the orderly development and maintenance of foreign exchange market in India. It was passed in the winter session of Parliament in 1999, replacing the Foreign Exchange Regulation Act. This act seeks to make offences related to foreign exchange civil offences. It extends to the whole of India, replacing FERA, which had become incompatible with the pro-liberalization policies of the Government of India. It enabled a new foreign exchange management regime consistent with the emerging framework of the World Trade Organization. It is another matter that the enactment of FEMA also brought with it the Prevention of Money Laundering Act of 2002, which came into effect from July 1, 2005. Unlike other laws where everything is permitted unless specifically prohibited, under this Act everything was prohibited unless specifically permitted. Hence the tenor and tone of the Act was very drastic. It required imprisonment even for minor offences. Under FERA a person was presumed guilty unless he proved himself innocent, whereas under other laws a person is presumed innocent unless he is proven guilty.
Switch from FERA.
FERA, in place since 1974, did not succeed in restricting activities such as the expansion of transnational corporations (TNCs). The concessions made to FEMA in 1991-1993 showed that FEMA was on the verge of becoming redundant. After the amendment of FEMA in 1993, it was decided that the Act would become the FEMA. This was done in order to relax the controls on foreign exchange in India, as a result of economic liberalization. FEMA served to make transactions for external trade exports and imports easier. Transactions involving current account for external trade no longer required RBI's permission. The deals in foreign exchange were to be managed instead of regulated. The switch to FEMA shows the change on the part of the government in terms of foreign capital.
Need for its management.
The buying and selling of foreign currency and other debt instruments by businesses, individuals and governments happens in the foreign exchange market. Apart from being very competitive, this market is also the largest and most liquid market in the world as well as in India. It constantly undergoes changes and innovations, which can either be beneficial to a country or expose them to greater risks. The management of foreign exchange market becomes necessary in order to mitigate and avoid the risks. Central banks would work towards an orderly functioning of the transactions, which can also develop their foreign exchange market. Whether under FEMA or FEMA's control, the need for the management of foreign exchange is important. It is necessary to keep adequate amount of foreign EXC from import substitution to export promotion.
Main features.
Activities such as payments made to any person outside India or receipts from them, along with the deals in foreign exchange and foreign security, is restricted. It is FEMA that gives the central government the power to impose the restrictions. Restrictions are imposed on people living in India who carry out transactions in foreign exchange, foreign security, or who own or hold immovable property abroad. Without general or specific permission of the MA, restricts the transactions involving foreign exchange or foreign security and payments from outside the country to India. The transactions should be made only through an authorized person. Deals in foreign exchange under the current account by an authorized person can be restricted by the central government, based on public interest. Although selling or drawing of foreign exchange is done through an authorized person, the RBI is empowered by this Act to subject the capital account transactions to a number of restrictions. People living in India will be permitted to carry out transactions in foreign exchange, foreign security, or to own or hold immovable property abroad if the currency, security, or property was owned or acquired when he/she was living outside India, or when it was inherited by him/her from someone living outside India. Exporters are needed to furnish their export details to RBI.
There are some highlights of FEMA, which are: it prohibits foreign exchange dealing undertaken other than an authorized person. It also makes it clear that if any person residing in India received any forex payment without there being a corresponding inward remittance from abroad, the concerned person shall be deemed to have received their payment from a non-authorized person. There are 7 types of current account transactions, which are totally prohibited, and therefore no transaction can be undertaken relating to them. These include transactions relating to lotteries, football, pools, banned magazines, and a few others. FEMA and the related rules give full freedom to residents of India to hold or own or transfer any foreign security or immovable property situated outside India. Buyers, suppliers credit. Trade credit has been subjected to dynamic regulation over a period of last 2 years. Now, Reserve Bank of India wide Circular Number AP Circular Number 24 dated November 1, 2004 has given general permission to ADs for issuance of guarantee letter of undertaking, letter of comfort subject to certain terms and conditions, issuing consolidated guidelines and process flow for availing trade credit. Definition of trade credit: credit extended for imports of goods directly by the overseas supplier, bank and financial institution for original maturity of less than 3 years from the date of shipment is referred to as of trade credit for imports. Depending on the source of finance, such trade credit will include supplier's credit or buyer's credit. Supplier's credit relates to credit for imports into India extended by the overseas supplier, while buyer's credit refers to loans for payment of imports into India arranged by the importer from a bank or financial institution outside India for maturity of less than 3 years. It may be noted that buyer's credit and supplier's credit for 3 years and above come under the category of external commercial borrowing (ECB), which are governed by ECB guidelines. Trade credit can be availed for import of goods only, therefore interest and other charges will not be a part of trade credit at any point of time. Amount and tenor. For import of all items permissible under the foreign trade policy except gold, authorized dealers (ADs) have been permitted to approved trade credits up to 20 million per import transactions with a maturity period from the date of shipment up to 1 year. Additionally, for import of capital goods, ADs have been permitted to approve trade credits up to INR 120 million transactions with a maturity period of more than 1 year and less than 3 years. No rollover extension will be permitted by the AD beyond the permissible period. Contraventions and penalties. Contravention is a breach of the provisions of the Foreign Exchange Management Act 1999 and rules, regulations, notifications, orders, directions, circulars issued thereunder. Compounding refers to the process of voluntarily admitting the contravention, pleading guilty and seeking redress. Functions of Enforcement Directorate. It is established by central government to investigate due adherence to the provisions of the Act by market participants. It is concerned with enforcement of the provisions of the Act to prevent leakage of foreign exchange occurring through various malpractices. It is an unsecured working capital tool that encourages exporters to offer importers extended payment terms. It refers to an instrument financing arrangement where the bearer sells the trade acceptance in its legal possession to bank, whereas bank deducts the discount interest on the face value and pays the balance to the bearer. Discounting trade. Acceptance is an unsecured working capital tool that encourages exporters to offer importers extended payment terms. Functions and features. It supports the development of commercial credit and provides credit support to address the short-term working capital need of the customer during the normal production and business activities. Target clients. The discounting applicants can be corporate and other organizations of economic activities compliant with the general provisions of loans of the bank and eligible according to bank's credit control requirements. Trade dilemma. Trade must work around a fundamental dilemma. Imagine an importer and an exporter who would like to do business with one another. Because of the distance between the two, it is not possible to simultaneously hand over goods with one hand and accept payment with the other. Benefits of the system. The 3 key documents constitute a system developed and modified over centuries to protect both importer and exporter from the risk of non-completion and foreign exchange risk, as well as to provide a means of financing. Protection against foreign exchange risk. In international trade, foreign exchange risk arises from transaction exposure. If the transaction requires payment in the exporter's currency, the importer carries the foreign exchange risk. If the transaction calls for payment in the importer's currency, the exporter has the foreign exchange risk. Transaction exposure can be hedged by the techniques, but in order to hedge, the exposed party must be certain that payment of a specified amount will be made on or near a particular date. The 3 key documents described in this chapter ensure both amount and time of payment and thus lay the groundwork for effective hedging. The risk of non-completion and foreign exchange risk are most important when the international trade is episodic, with no outstanding agreement for recurring shipments and no sustained relationship between buyer and seller. Now in the end, let us summarize what we have learned in this lecture. When a government guarantees or insures a loan made to finance an export, it creates a financial instrument against which the lending institution, either a bank or an exporter, can borrow at rates close to the government borrowing rate. An important observation that needs to be made is that through this master circulation, the RBI seeks to promote foreign investment in microfinance and MSMEs. The government wants to encourage the growth at the rural level along with the urbanized areas. External commercial borrowings are becoming an important source of funding for companies in India. The most important advantage of external commercial borrowings is that it gets in foreign exchange in the country. The designated authorized dealer AD shall have the general permission to make remittances of principal, interest and other charges in conformity with the guidelines on borrowing in foreign exchange from overseas issued by central government, the Reserve Bank, from time to time. The main objective of FERA was conservation and proper utilization of the foreign exchange resources of the country.